Well, good morning, everyone. Welcome to the second session. I'm Jeff Cole from the Carrot Project. So, a little bit about me. I farmed full-time for 20 years. I ran a nonprofit for 20 years. That means I'm old, and it means I have some biases. So just don't be afraid to question me in anything I say. I also have hearing aids because when I was farming, we thought tractor mufflers were sufficient to protect your ears. So any of you who are starting farming, wear hearing protection unless you like wearing hearing aids. And I will tell you, with masks, it's a pain in the butt. So there we go. A little bit about me. All right, this is part two, financing. A little bit about the Carrot Project. I'm not going to read all of this. I just want to point out that we are focused on addressing gaps, not duplicating what other organizations and banks and other institutions are doing, but supporting that work. We try to focus on agricultural businesses, local agricultural businesses, or fisher people, or food producers who are using local agricultural ingredients. So an example would be someone who's producing cold-pressed juice. If they had a line that included carrot juice and beet juice and mixtures of that and kale and spinach or whatever, fine. If it was someone who was simply looking to make mango juice, we wouldn't offer our support to them. It's not mean that we wouldn't point them in some other directions. We wouldn't just leave them hanging per se, but we wouldn't actively work to support them. I'll give you a few minutes to read this. Some of our core works are training and workshops, loan programs. We have a loan guarantee program. We don't make direct loans, and we'll guarantee up to $50,000 of our producers' financing. That's often sufficient to leverage twice that or more. We work with one core partner right now, which is the Franklin County PV Grows Loan Fund. We also work one-on-one with people either through business advising, which is a longer, more intense engagement, or coaching, which advisors will do, or Amanda or myself will do, depending on the situation. So the agenda for today, we're going to talk about preparing for financing, a little bit of some fundamentals from our perspective, and where to look for some money. So preparing for financing. This slide is our slide to indicate that, yeah, if you're going to look for someone else's money, you're going to have to conform to some pre-existing terms and conditions. However, it doesn't mean that you don't have a little bit of flexibility to create your own unique situation. So here you go, you got a bunch of young guys in suits with muck boots on. That's our message. So when we're talking about financing, we're talking about loans, grants, investors. They all have a slightly different relationship to the business owner, but they're all some form of financing. To some degree, we would put like a social media campaign to raise funds, like a GoFundMe. That can, depending on how you run it, be sort of more in the investor bucket or more in the grant bucket, but they're still in that kind of bucket, all right? Now, all of this is based on what makes you a good risk or not a good risk. And I want to point out that if you use your own money to start your business, you have functionally made a loan to the business. And even if you're a sole proprietor, you've made a loan to yourself. My point in pointing that out is if you don't somehow formalize how much money you're putting into the business and create a plan to pay yourself back, it's highly unlikely you will ever get paid back. And I'll use myself as a personal example of that. When my wife and I started the farm 40 years ago, she had the off-farm job, I ran the farm. Over the course of 5 years, which is the average length of time it takes a farm to produce a profit, we put over $150,000 into the farm. We kind of kept a loose track of it. We never created a plan to withdraw that money from the farm business and put it back into our bank account. And 40 years later, we haven't. And I say that because for any of you farmers who are looking to create a multi-generational business, it begins to put a lot of pressure on your next generation if they have to pay back that investment and it's coming from their personal funds versus building into your farm financing the dollars to pay that back for them, if that makes a sense. What makes you a good risk? There are the five C's of credit. Character, capacity to repay, conditions, covenants, capital, and collateral. Today I'm going to focus on character, capacity to repay, and conditions and covenants. Capital and collateral are less and less important 5 C's of credit in the farm lending or farm and food lending world. It's not to say that they don't exist. If you go to a commercial bank, capital and collateral are likely to be important. But in our sector, as I said, character, capacity to repay, and conditions and covenants are more important. So the capacity to repay, I'm going to focus on that first, basically is your cash flow. Do you have enough money moving through your bank accounts, whichever you're going to be using to pay back a loan, to actually be able to consistently show that you have the cash in the bank to make your monthly payments, or yearly, or whatever your term is set at. So that is determined by 2 factors: your current business and its cash flow, if you're already in operation, and in all cases, your future projections for cash flow. Cash flow is based upon, especially projections, your business plan and your projected finances for that business plan. Those two are coupled because whoever is providing you credit wants to understand whether your plan is realistic. And they'll use a whole bunch of tools, a whole bunch of economic metrics and so on to evaluate your plan to say, yeah, it's realistic, or no, it's not realistic. Character, it's pretty self-explanatory, I hope. It has to do with what your place in the world and society is in relationship to whoever's investing in you. How do they perceive you? How does the rest of the world perceive you? You know, have you defaulted on past loans? That's an issue, right? Have you had a really strong social media presence that is a contrary position to either the majority of society or to the people who you're looking to get money from. I say that because I find more and more, and I know we've all heard stories of it, but I want to point it out. Your social media presence can impact how people view you, and it's something you should be aware of, whether it's a fact. That's one of those conditions in life that conformity becomes a factor that impacts your access to capital. I hate to say it, it's just the way it is. When I was younger, I used to fight about things like that. Now I'm old, I'm too tired, and I say, that's the way life is. And so for you younger folks, I'll let you fight it if you want. Now I'm recommending put your money into getting your business going and time into getting your business going, not fighting these social norms. I don't think it's going to be ultimately all that effective. Now, conditions and covenants. That relates to your capital and infrastructure that you currently are using. So, do you own the land and the infrastructure? That speaks to collateral, but that's a condition of that physical space, if you will. Do you have a lease? Is it written? Is it long-term? Is the land and the infrastructure and the equipment that you have in good shape? That's a condition, right? Covenants. Does the lease provide materially for active farming or not? So I'll use an example. The core example is from a Massachusetts situation, but I suspect it also applies in Rhode Island, which is you have land, you're leasing the land, and you're leasing it from a conservancy whose primary goal is to keep the land open and vegetated in some way, shape, or form, and looking nice for the community. Your farm plan may include a greenhouse to increase your productive capacity, to address climate change, to have season extension, to grow more valuable crops more reliably. You may find that even though the lease says you can have a greenhouse, when you go to put it up, the conservancy, the people in the community say, it's gonna look horrible, no, you can't do it. Now you have a choice. You can fight them, enter a legal battle, probably end up in a negative relationship. You're still farming, but every time you turn the corner, something's gonna happen because they're unhappy with you. So that's just one example of being really clear about what can and can't happen and the type of land, if you're leasing it especially, that you're using. But it also happens if you buy it, right? There are programs where you can buy conservancy land, right? And versus agricultural preservation restriction land, which is designed specifically to support agriculture. So those are conditions and covenants and some of the things you need to think about. So getting into some of the details. Well, what makes you a good risk? Having an updated business plan. Business plan is not something that you create once and goes on the shelf. Life, we all experience. Life changes you on a daily basis almost. So your business needs to consider those changes and you need to update your plan. We want to look to have some clear goals and objectives, right? Knowing what you're looking for and why. You want to have good financial records and projections. One of the ways that you create good financial records and projections is consistent and accurate record keeping. Now, we're focused on finances, so my focus of this conversation is going to be on financial records, but I do want to point out that in food production businesses, the production records are critical to pair with your financial records to actually understand what's going on in your operation. You can say, I grew $500 worth of beets. But if you don't know if you grew $500 worth of beets on 10 acres, or 1/10 of an acre, or 1/1,000,000th of an acre, and how you did it, it's not totally effective for you in terms of running your business. Good financial records and projections establish your ability to repay or complete the project. So when I say complete the project, I'm more referring to a grant situation where the risk that the grantor is taking is that they give you the money and you don't use it properly or well and you don't finish the project. And they have goals, and their goal was to achieve whatever goal was going to be met by your project. And obviously, if you don't finish your project, you're going to not meet the goal. So again, I will use a example from Massachusetts in terms of a government grant. Right? Years ago in Massachusetts, a government grant was given to a business, and they went forward and they started to work and complete the project, but they never did. It caused the TV investigative team to dig into this for whatever reason, and in that research, they found negative background information about the business owner, and it was all over the news. And the state was lambasted. X amount of dollars go into a wasted project for this individual who was convicted of this crime. I don't want to go into details, but it wasn't just a minor crime. Let's put it that way. So I say that because your grantors are going to be looking at, are you going to give them a black eye if they give you the grant? And you should be aware of that. And then finally, a good relationship with a bank. If you're working with a bank and you have a good relationship with a bank, it makes your life easier. They are a potential source of revenue in terms of a loan or a line of credit for you. And we'll talk a little bit about loans and lines of credit in a bit. So what are the fundamentals of good record keeping? Your books. First, understand whether your business is going to operate on a cash versus an accrual basis. I'm not going to go into the details of cash versus accrual. I simply want to point out cash makes manipulating your cash flow statement easier. Accrual makes up lining your income and your expenses so they're periodically in the same period much easier. It also gives you some fundamental principles to move things around in accounting terms to more clearly represent what you want to represent in a financial statement. There are things called good accounting practices that you must follow, but within those, you can do things that you can't do on a cash basis to change the way you see and explain what's going on financially in your business. The balance sheet. The balance sheet is a function of your books. It is a simple equation that says that you have assets and you have equity and liabilities, and they must always equal. What we see very frequently is slight mistakes in categorizing expenses and income in your books materially impacts your balance sheet. And when you go to a lender, they're going to look at that balance sheet. And if it's all messed up, someone has to go through and do the work to clean it up before they're going to understand whether you're a good risk or not. Cash flow projections, we talked about already. They're a core function of your business plan and how you're looking to both gain income and how you're going to pay for the expenses you have in running the business. And finally, consistent practice is what makes good record keeping good. So a little bit on the cash versus accrual. I'm not going to read this. I'll let you all read it and ask me questions. For our purposes, the core principle is to know which system you're going to use and why you're using it. That will allow you to explain to yourself, to business partners, to people who are lenders or potential lenders, what's going on in your business and why. The question is cash accounting embedded in accrual accounting? Yes, technically yes, but it's embedded in simply the way the cash is recorded and moves through the business. They're two separate principles. So cash accounting, when I hand you $1, you've received the income. When you pay, let me get very specific. I buy a quart of strawberries from you. You produce the strawberries. When I pay you the $1 for that quart of strawberries, way too little, yes, I understand, then you record that as income. When you pay the vendor who you purchased the quart box from for your fertilizer supplies, for the plants that you use to plant in the ground to produce the strawberries, when you pay those bills under cash accounting, that's when the date of payment is. So strawberries is a good example. You buy the plants, you put them in the ground a year before you get income. So your expenses in that first year are not, of the plants, are not lined up with when you get the income. That impacts your financial statement, it impacts your tax position, it has a whole bunch of downhill, impacts. However, it's real simple. You've got your cash flow statement right there. It's right there in front of you. This is how much cash I had, this is when I paid it, this is how much went out, and so on. With accrual, you change that and you say, you can change it. I'm buying my strawberry plants this year, but I'm going to record that as a cash expense that will be expensed the following year. And so it sits there in this pool, a puddle of unclaimed expenses that you claim when I pay you the $1. And it allows you to line those things up, those elements, more easily. Then you have to do some, I'll call it fancy math, to create your cash flow account from that. But honestly, and from our perspective, that fancy math is not all that complicated, number one. Usually for running a business and making management decisions about how that business is going and what changes you need to do better, it's functionally easier under accrual accounting. You see things together versus, oh wait, I got to remember, 3 years ago I did this and now it's really when it's coming home to roost. Right? Yes, right. So for those of you on Zoom, I'll try to summarize. Accrual accounting allows you to create a timeline of the business operations that go hand in hand with each other and you see them together, whereas cash accounting creates a timeline that's only based on actual calendar date. So again, for those of you on Zoom, there are pros and cons to both ways of doing it. Cash accounting it takes only a view at what you have now today, both for income and expenses, or in a short time frame. Accrual accounting allows you to look at what you had for expenses in the past, what you expect for income in the future and expenses in the future, and what you have now. It allows you to put all of those elements together in one view.
But it's not one or the other. You're going to have to use both.
It's so in terms of bookkeeping, you have to make a decision to do one or the other. If you try to do both at the same time, for legal purposes especially, you can't, right? The government says you have to pick one or the other, right? And there are tools to make adjustments, but your book should always be reflecting one or the other. There's no right or wrong decision, right? We're not saying that you should definitely be accrual or you should definitely be cash. It all depends upon the individual circumstances of the business, your individual circumstances of being comfortable with an accrual system or being comfortable learning it if you're going to run your own books, or being comfortable with and having the cash flow to hire an expert to do it for you. It does vary depending upon the amount of exposure to these concepts that the individual business owner has before coming into the business. I think it's fair to say if there was no exposure to these concepts, probably cash for a little while until all of a sudden they're not understanding the business. And then they'll talk to somebody who's more expert in it and they'll make their decisions on what they want to do. But I think it's fair to say that probably cash the majority of times for those people, again, who haven't already had some level of understanding of these concepts and made a decision as they started up their business. I will say you can change if you want. You have to essentially request that change with the IRS. You know, you write a letter and say, this is what's going on, I want to change. I'm not a tax professional. I don't have any clue as to the percentages of time the IRS says yes or no. But I do know that that is, you know, functionally the case, and I believe the states follow the IRS decision. I believe it is probably functionally the case that most nonprofits operate on an accrual basis. Particularly, you got a grant, you get the money in 2022, but your grant project is in 2023, and you want to line those up. You don't want to have to record income and no expenses, especially as a nonprofit, and then potentially have the concern of reporting to the government on your 990 form why you have all this money. Because you're supposed to be nonprofit. They shouldn't, you know, I mean, there are tools. It's not like it's a major issue, but it could, if it's a big chunk of money, especially compared to your yearly operating budget, it may raise some eyebrows and you may be asked to justify what this is, and an accountant would work with you to classify that income not as actual income, but under a different category, retained earnings, or they would put it in a liability account. Accrual accounting would let you do that. Say, yeah, the money came in, so the cash shows through, right? But it doesn't go into the income account. It functionally goes into a different account that is intended to be used for the following year. All right, the balance sheet equation, as I said, I briefly touched on it. I'm going to briefly touch on it right again. You've got assets equals liabilities and equity. The owner's equity could be your equity. It could be investors' equity. It's a pretty simple equation. Why this is important is because how you record, especially expenses for capital, significantly impacts the view that you and the bank will see on that. So here's an example. Very simple example. You have a business, you gross $100,000 a year, you decide you're going to buy a greenhouse, or you do buy a greenhouse, it's $15,000. You decide that you're going to expense it. I'm not going to get into the IRS regulations about whether you can or can't or whatever. Take it for granted that you can expense it. And if you choose to expense it, what you see is you have a net profit of $25,000 and you have no assets. On the other hand, if you record it as a capital expense, which means then you'll be depreciating that value over time versus expensing it all at once, all right? What do you see? What would the bank see? See, you have a net profit of $40,000 and you have $15,000 in assets. So when we go back to, are you a good risk? What do you think a lender is going to decide based on this scenario? I think it's probably pretty clear to all of us, right? Recording it as an asset is going to give you a better picture for a lender, an investor, or someone who and ultimately for yourself. Now, where I'm headed with this in one sense is don't run your business. Our recommendation is don't run your business to play the game of reducing your taxable income to the lowest possible amount. There are mechanisms within the IRS code, however, that after you record it as an asset will allow you to do that. In this particular case, and again, this is not tax advice, I am not a tax expert, but there is IRS code section 179 that allows a business to take up to a maximum dollar amount, a capital asset that would otherwise be depreciated over whatever the asset life is, and take it all at once. But your books are still showing this. Your tax preparation and your tax filing and forms show something different. Bank understands that, right? Investors understand that. They will look at both, quite honestly, but they are going to be more concerned and focused on the balance sheet and what that says than the tax filing, because of the manipulations that you can do legally to impact your net taxable position. Thanks, Josh. Summary for those of you on Zoom, accrual accounting allows you to maintain a record of accounts payable, which is what you owe other people, and accounts receivable is what people owe you. In an accrual system, the accounts receivable get recorded under your asset line, and people see that, and the accounts payable gets recorded under your liability line. And by doing that, businesses can use the terms of payment, or both in terms of what are your terms, what are your demands, what is your time frame that you're expecting people to pay you in, versus what is the time frame that you're expected to pay on. And you can manipulate that to some degree to create a more positive cash flow for your business. And Josh was saying he's seen a number of businesses be able to do that and take that increased cash flow and put it directly into growing their business, which essentially is what startup businesses usually need to do anyway. You need to take your cash flow usually and grow your business, because you don't normally start a business where you want to be. So I'm going to repeat your question so the Zoom people can hear it and make sure I understand it. Are you asking if it's more frequently the case that in the food system people use accrual accounting versus cash?
No, I mean in terms of taking advantage of...
Managing the cash flow. I think it's consistent in any business. If you understand the principle, if the business owner or the chief financial officer or whoever's responsible for making those decisions is aware of that, yeah, I think it's very frequently the case that people use whatever tools they have to maintain the a positive cash position and cash flow in the business. We do it in life, right? The check is in the mail, right? So it's kind of universal. All right, any questions on this concept of where to record and how it works in terms of expense versus an asset?
I'm sorry, I'm looking at the numbers. So how is a net profit and assets is 40,000? Oh, I got you, because 100,000 and then 60, I got you. All right.
Right, because you didn't expense it in the second case. You will expense it. So maybe this might get a little bit too detailed, and tell me if it is, but you will expense an asset, but again, it's under depreciation. Depreciation comes on a different line in your income statements. Income statement is your statement of revenue and expense. Below all of that, so then you end up with your net revenue. Below all of that is where you record your depreciation and other asset costs. It's not that it's not in your books, but it shows up in a totally different place and it looks totally different in those two scenarios. In one case, it's showing up in the expense side in your expenses. It's showing up in your bottom line. In the other, it doesn't show up into your bottom line until you add the expense line in and take whatever percentage the IRS says for that particular class of assets that you can take in year 1, year 2, year 3, and so on. And so then you get your net revenue that does impact what your income statement, your income is on your tax form, but your books don't show it in that top line in this scenario. Does that make sense? I really didn't intend to get into these levels of details, and if it's not helpful, let me know. If it is helpful, I'll keep doing it. All right, now getting into cash flow projections. You can do this in a spreadsheet. You can do it on a paper ledger. This is just an example. It's a made-up farm. It's a made-up example that we use in our trainings. The goal here is to simply show you that you have a section that is for income, and you have expenses, and you have a section for expenses. Now, we always talk about variable expenses versus fixed expenses. In that previous example, a variable expense is something that changes with the volume of your production. So labor would be a variable expense. We assume that if you grow 1 pound of beets, you need a certain amount of labor. If you grow 500 pounds of beets, you're going to need a certain percentage more. Certainly the cost of seed, fertilizer, et cetera, is variable on production. The greenhouse, that's not variable. So I just kind of touch on that. I don't want to go into the details. What I want to focus on is the fact that you have these records, you lay them out on a monthly basis, you can sum them to the total for the year, and then you can use the net result, which we don't show, we don't have enough room on this slide, right, to understand what your cash flow is. It's the sum of all your income minus the sum of all your expenses will give you a cash position. Then following to the next month, that also happens, and you can look at the difference. And that's your cash flow, right? You can add it all up to the end of the year and say, well, come June, I'm going to be really tight. I better try to save some money, or I'm going to put off paying some of these bills. But by the end of the year, I got plenty of money, right? So not only does it allow you to make management decisions, but again, in terms of financing, the bank can look at it and say, okay, you got enough money at the end of the year. We'll give you the loan, provided we see you got an issue in June. You got to tell us and guarantee to us that in June, you're going to take actions to make sure you can pay us. And that's good for you to understand as a business operator. Now, how many of you have smartphones? How many don't have smartphones? If you have a smartphone, you have a computer. What I have heard recently from some farmers getting into the business is, I don't have a computer, I don't know how to run a computer, as they're looking at their smartphone. And so my recommendation, our recommendation of the Carrot Project is to strongly consider, when you're looking at managing your cash flow statements, to do it in a spreadsheet, which means getting a computer. You don't have to get Microsoft. There are plenty of free softwares out there. There's Google Sheets. There's any number of other programs that will create a spreadsheet for you. And this is why. When you go to do projections, you're going to be manipulating those numbers. If you have a big paper ledger, then you are going to have to re-record all of the static information that you have on ledger page 1 onto ledger page 2 by hand, and make your adjustments. Or you're going to have to take an eraser and erase this one and make an adjustment, and erase this one, and then do all the math with a calculator. You're going to have to use some form, likely. I mean, if you're a real math with you probably do it in your head. But when you've got a chart of this many numbers, the probability of making a mistake when you're doing it manually is about 99%. And so because of that, we strongly recommend as a first step of running a business, get a cheap computer. It doesn't have to be a really expensive computer. It can be the bigger the screen when you're working on a spreadsheet, the better you are. So if you don't intend to be using it remotely and taking a computer along with you, get a desktop. They're a little bit cheaper. Get a big screen. Yeah, find the financing. If you don't have the cash, you can probably do it for $500. We would say find that financing first so that you can make your life so much more accurate and easier and ultimately quicker when working with your books. And why do we think that's so important? The single most precious commodity every single business owner and most every person on this earth in this day and age has is time. And being able to work through your financial stuff quickly and accurately, and then get to the point of actually getting out and getting your hands dirty and producing whatever you're producing is critical to be successful. All right, so we've taken an existing set of records and we said we're going to make projections. We're going to change them. We still do it on a monthly basis, right? And you can see the results. So you got the column now called annual projection. In our spreadsheet, because it is a spreadsheet and you can put in formulas, we have a column called remaining, meaning you can set your goals and say, I want to reduce my expenses by this, or I know I'm going to increase my expenses by this because I'm increasing whatever it is. But you can have this quick column to see if your projections are starting to line up with your expectations. And again, it's formulaic. You don't have to do the math. It's done for you. You just type the numbers in to your spreadsheet, and it's there for you. So again, one of those very significant time-saving elements that allows you to second check your assumptions when you're saying, I want to do this in the future, and how that's going to impact your financial position. All right, what about bookkeeping? Will your books ever be perfect? No. Accountants live on the fact that books are never perfect, and they're hired to fix the mistakes and do whatever reporting to government that has to have happen. All right, you will get better. Your books will get better. Better books make for better information, etc. I'm not going to read this all. You can do it. What I'm going to say is that what consistent bookkeeping gives you is current profit and loss statements that are accurate. You know where you stand today, right? It gives you accurate cash flow projections and statements. That shows not only to you that you can understand where you're at, but it shows that you understand the impact your business is having on the lender, or your capacity to pay the lender, or the grant, or whatever. And more importantly, by using projections, you can show you really understand the impact a financing option will have on your business today and in the future. That gets right back to the two things around, with the 5 C's of credit, which is ability to repay, right? And your character. Your character now, you're saying, I have a character that pays attention to this and focuses on my impact to my lender, my investor, etc. The current balance sheet, if you have an accurate current balance sheet, it shows your wealth. Again, it's not so much of a focus in today's conversation, but your wealth essentially is your collateral for a lender, right? So if that's accurate, then they can say, okay, well, we're not going to use it. We've decided that we're not going to seek collateral. However, they know they have the option that there is collateral there, right, that they can work with you to figure out what to do if you're having trouble paying them back. If it's not collateral, I won't get into the legalities. I'm not going to go there. So, what are we saying, right? You're the competitor. Financiers are betting on you. All right, so what one option for financing is a loan. A loan is a sum of money, generally from a bank, generally for a specific purpose, with an agreed upon timeline for payments and agreed upon interest for payments. Credit cards are often issued by banks. They come with their preset repayment terms and the rates spelled out in the agreement. If you use it and don't pay back the full amount when it is due, you have taken a loan. Many businesses do that. It's not destructive if you have the capacity, the cash flow, to pay back those very high interest rates. Pushing the pencil to determine whether that easy loan and those high interest rates are to your benefit is something we say you should be doing, versus considering a longer term or different financing situation with a different lender with lower interest rates. Line of credit is simply a different form of a loan. Line of credit is a loan that is a revolving balance. It's preset. If you will, the money sits there in the bank account. You're attached to it, and whenever you draw on it, they move the money from their account to your account and start charging you interest. Typically, line of credit have a repayment term that says at the end of the year, we expect your balance to be zero. We expect you to take this money for operations. We expect you to make a profit. We expect you to put that money back in. Doesn't always have to work that way, but that's sort of the typical amount. The nice thing about lines of credit, for instance, is they can be used for a bridge loan. We're going to get into the grant world, right? A lot of grants, and I'll touch more on this, in the food sector is performance grants, meaning you get the award and they say, when you complete the project and you prove to us you've completed it to our satisfaction, then we'll put the money in your bank account. If you got a $100,000 grant and you don't have $100,000 cash in the bank to do the project, you're going to need to get that cash. A line of credit can be that. There's a bridge called bridge financing. You can go to a financial institution and also get a loan. And they can be a little bit easier because essentially that grant is the collateral. But again, they're banking, the lender is banking on you actually finishing the project to the satisfaction of the government. So it's not like it's just a slam dunk. You still have to prove that you have the capacity to do that project with their money. Oh, here we go. We got into grants. As you recall at the beginning, I said I ran a nonprofit for a number of years. I can tell you categorically that grants are not free money. Amanda can tell you categorically grants are not free money. The Carrot Project, Amanda and I just finished 5 federal grant reports. Federal grant reports are probably some of the most burdened grant reports. Amanda and I collaborated for 2 weeks to create those 5 grant reports. That's not free money. Take all of our time, right? That's just the report. That's not the time implementing the project, right? So I'm not saying grants aren't decent and good options, but be real clear. They're not free. Investors, a person or company providing capital, often in exchange for ownership equity. It gets back to, did you put money into your own business? Well, you're your own investor. Consider treating yourself like you would any other investor. You have a repayment plan, right? The thing about like venture capitalist investment, their goal is one thing and one thing only. That's to get your business up and running, increase its business value substantially, typically 5 or 10-fold, and as soon as it hits that mark, 5 or 10-fold, whatever their metric is, then sell to someone else and take the cash out. Right. So what that means is, generally, venture capitalists own 51% or more of your business. They make the decision. If you've got a great business, you've got great cash flow, and you've got all the assets, and you can buy it from them after that 5 or 10-year term, great. That's not frequently the case. Frequently, you're forced to sell, and you put money in your pocket too, yes, but your business itself now is run by somebody else. Any questions? So alternative investing, crowdsourcing, again, it depends on how it's run. Right? Nonprofits can use crowdsourcing where you don't really necessarily deliver a product. A lot of for-profit businesses say, hey, I'm producing the best widget in the world, give me $10 now, the widget's gonna be worth $30, I'll give you a widget in 5 years. Right? That's, you have an obligation. Right? It's not like you just got the money for nothing. Ready to move on? So making yourself a good bet. Recap, with a loan, will you be able to pay off? With a grant, will you be able to fill the terms of the requirements of the grant? Will that investment support the goals of the grant program? Individual investors, will it provide a return? Will the investment support our goals? We're all aware now of green investing, right? Where there are a whole host of investment people who are either individually or in mass looking to invest for social causes. That changes the parameters of what they're looking for, but they still want to meet those goals. Banking history, as I said, having a good relationship with the bank is always important or helpful. Perhaps is a better way to express it with getting a loan. All right. So, do you have good credit? Do you have a good history? Right. They are both related to your established patterns of behavior with money. Right. For those of you on Zoom, the comment was getting a loan is not a one and done deal. Getting a loan establishes a relationship with the bank if you don't already have one. And I think what Amanda was trying to say was that if you already have a pre-existing good relationship with the bank, it makes the process of getting a loan or an additional loan that much easier. But at the end of the day, her core point was getting a loan is establishing a relationship. Your business plan. What are the goals and benefits of the business plan? So as you thought about your business, where it is, where it's going to go, and how you're going to get there. Anybody who is looking to somehow invest in your business is going to want to know the answers to those 3 key fundamental questions. As a business owner, if you can't answer those questions, it's not likely that you're going to meet your objectives. I'm not saying it's impossible. I'm just saying it's just that much more difficult. The business plan specifies what you're going to use your money for, right? And it will indicate numerically how it's going to impact your business. That in particular is where your production records, if you have a history, or creating a history of production records, plays hand in hand with what's going on in your business and how it impacts it. All right, so this we call the wish list method, right, is a spreadsheet, right, with assets and expenses that you want to create for your business, and you maintain this. It's a wish list. This is not what you are doing. This is what you want to achieve. And you can create projects. I want to create the cannery project. I want to create the beets in the greenhouse project. I want to create the selling whole fish project. I want to create I'm a nonprofit and I want to provide incubator space for people to do X, Y, Z. So you list those projects out and you start to assign what you expect to need to have for expenses and assets, maybe income if it's income-based, and you just maintain a look at that. And then when you see an opportunity, like a grant opportunity, that seems like it will fit, you've got the numbers already there. It's copy and paste. Literally, if you keep an electronic form, it's literally copy and paste into the grant application. And why is this important? Grant writing, pardon my French, sucks. The easier and more succinct and accurate you can make it, the better it's going to be for you. The more likely you are to win the grant. But more importantly, the less investment you have in not getting the grant. Even the best grant writers don't get awarded 100% of the time. So part of your costs in getting into grant writing is that ratio of how much time and energy did you spend writing grants as a whole box, and how much did you receive? How many did you get funded and what was the dollar amount, right? And simple math, right? If you value your time at $100 an hour and you spend 100 hours, you spend 1,000 hours writing a whole series of grants, and you return $50,000 out of that whole pool, you've gone backwards by $50,000 economically, financially, so to speak. Now, if you're not paying yourself, it may not be cash, but you still have that emotional investment, and you still have that time, and then in economics, you have what we call the opportunity cost. With that time that you spent not getting grants, what could you have done? Could you have grown beets and sold them and made a profit of X amount of dollars? Or rented incubator space for Y amount of dollars and made a net return on that? Right? So those are all things that as business owners you need to evaluate. It's part of your business plan and evaluating your business plan. So with all of this wish list method, be clear, right? You're not going to get it all. It's not likely you're going to get it all at once. So you maintain this, you check off what you get, you adjust it as you're moving on. You say, well, actually, I thought I was going to do canning. I've decided that's not going to work. I've got a different project. Right? All of that plays out in this spreadsheet. And again, if it's not handwritten, you don't have to spend the time handwriting changes. You can simply save that old version, create a new version, make changes. If you've got formulas in there, everything adds up for you, and you've eliminated all of that time. Finding financing. People want a break? 2-minute break, or are we good? All right. Finding financing. Loans. You can look at banks, credit unions, community development corporations, particularly in the food system. There is more and more interest from community development corporations, CDFIs, community development financing institutions. It's a subset of CDCs, community development corporations, right? they have a social mission. Many times the social mission is economic development. So if you can play into that economic development bandwagon, they typically have pretty favorable terms. Now, what do I mean by that? They typically are taking more risk than your typical bank institution. So the interest rates may be higher, but their repayment terms, their loan forgiveness terms, their capacity to work in a situation where they know you're getting a grant and they're using the grant as informal collateral, all those things come to bear with mission-driven investing. In this case, CDFIs or CDCs, right? Platforms like Kiva, which is an online lending platform for the food system. They're capped at $15,000, but if you don't need a huge amount of capital, that's an option. There are other platforms like that. Kiva is not the only one, right? Nonprofits like the Carrot Project, where we have our loan guarantee fund. There are other nonprofits that have actual loan funds to use, all right? Farm Credit East, if you're in the farming system in particular, right? They're a lender. And of course, there's the federal government or state government, the Small Business Administration, USDA for agriculturally related lending, your state government with various programs. Typically at state level, and Josh, tell me if you think I'm wrong, if he's still here. State programs for lending typically revolve around economic development. That's their core goal. So whatever you're doing, you have to show to that lender that you are increasing the level of economic activity in your community. It could be as simple as you're going to hire 10 people who are from the unemployment rolls, right? That's your plan, that's your project, right? Or it could be much more complicated than that. Grants, or I talked about grants, in terms of where can you get them in Rhode Island. Rhode Island DEM, National Resource Conservation Service, SARA, Sustainable Agricultural Research Enterprise, or whatever, it's a grant. As I said, USDA, local organizations. Investors, I talked about it. Keyword Steward is another online fundraising platform. Crowdsource is a list of a bunch of crowd that I quickly put together, right, for crowdsource opportunities. Some local organizations are also investors. Rather than lending, they will seek to get, they'll take an equity position, meaning they will give you money for an ownership of the piece of the pie, or a promise for a return of something that's not simply cash and interest. Right? It could be that you're producing something and they want 100,000 pounds of beets, and they'll give you a certain amount of money, right? And you deliver them the 100,000 pounds of beets. At one level, community-supported agriculture is an investment position. So in summary, let's see if I've followed along with no, that's the end of it. We think you need to focus on bookkeeping practices and projections. That doing that is going to make you a good bet, and that having it all organized and put together makes it much, much easier for you to apply for whatever kind of financing you're going to apply for, be it a grant, be it a loan, be it an investment opportunity. Again, as I said before, you've got it written out, right? You've got your business plan written out. You can literally, if it's an electronic format, copy and paste the relevant portions of your business plan into the loan application, into the grant application. You've got your financial picture. You literally copy and paste into the sections of whatever application that you're working with. It makes it so much functionally better. And, assuming that you've kept it up to date, it's accurate. You don't have to go back and double check your math, right? Because you're not making the numbers up on the fly, because it's already there. To do all of this, you don't have to be out there on your own. There are all sorts of organizations that provide support. The Carrot Project does, right? The Rhode Island Food Policy Council does. Northern Rhode Island Conservation District does. Your FSA, Farm Service Agency, officers can help you, right? Rhode Island Small Business Development Center. They're all resources. And if they can't help you, almost all have contacts to suggest other names that might be able to help you. Okay, so I'm going to rephrase it for everyone and make sure I heard you. So you're a nonprofit, but you're not a C3, and you're looking for grants that require the C3. So a C3 is a nonprofit charitable organization under the IRS code. And there are grants that are only available to nonprofit charities. And the question is, can you use a fiscal sponsor generally? And I think your question was, is Carrot Project set up to be a fiscal sponsor? And so the first part of the question is, yes, fiscal sponsorship relationships are very common as a way to access those funds that are only available for charities. The Carrot Project is itself fiscally sponsored by Third Sector New England, and so no, we functionally and fundamentally cannot, as the Carrot Project, serve as a fiscal sponsor. And if you would want to use Third Sector New England, you approach them. We have no functional relationship with their decision-making process, right? We could help get financial projections together and that type of thing for that approach, but we wouldn't be able to, manipulate the system, so to speak, to get you any advantage or I suppose on the other side of the coin, disadvantage by going through us, right? So for those of you online, in addition, the United Way or potentially SE Greenhouse, they used to do it. I'm not sure that they do fiscal sponsorship anymore. And what was the third?
The Rhode Island Foundation.
The Rhode Island Foundation.
But they might be able to.
Right, they can. Rhode Island Fund might be able to connect you. Yeah, I mean, certainly any of the organizations that work in the charitable sector, have some connection with fiscal sponsors or potential fiscal sponsors. The caveat is it's not always the case that charities are willing to share core information of their primary and core funders, right? There's sort of a conflict of interest. It doesn't necessarily always have to be the case, but developing those good relationships with the charitable system in your locale, right, is always a good way to test the waters if you're looking to be a nonprofit. And as you pointed out, you don't have to be a charitable nonprofit. You can be a nonprofit, which means you don't intend to make a profit without being a charity. And there's a whole number of them under the IRS code. Fraternal organizations, social benefit organizations, they all are, and they all have their own niche in this charitable nonprofit sphere that comes with pros and cons, right? Again, I'm not a tax expert. I am not a fundraising expert in terms of the whole sphere. I simply have been around for a long time and have been exposed to some of these elements. So I can only encourage you to find the best experts in your neck of the woods, right? Local is usually better. You develop a relationship, right? They become to trust you, you become to trust them, and then you start getting more actionable information.
Hi folks, so I'm Josh Daly from the Rhode Island Food Policy Council. I met a number of you last time and then other times. So Jeff mentioned different grant programs that are available. One of those programs that's available is called the LASA program, LASA, Local Agriculture and Seafood Act program. It's a grant program from the Rhode Island Department of Environmental Management, DEM. It's for beginning and small farmers, fishers, aquaculturists. The grants are up to $20,000. You can be, to the question of, you can be a nonprofit who works with farmers, fishers, aquaculture folks, supports them specifically, or a nonprofit that is engaged in some farming activity or other related activity. Or you can be a for-profit for sure as well, or a cooperative. Or it's pretty open-ended in terms of the legal entity structure that you can be. Up to $20,000 can cover a lot of different things for you. Jeff talked about that wish list. If you've got that wish list, this is a good way to look and say, what could we fund through that? So if you go to, I'll just say you Google DEM LASA, L-A-S-A, you'll get to the DEM page, which has all the information about eligibility, has all the information about the requirements for the grant and all of that. We also, Food Policy Council, are providing free assistance to folks. I know some folks have already taken advantage of that. Free assistance to folks applying for the LASA grant. And we have that available in English, but also translated as needed. So you can reach out. That's also on that website, or you can talk to me afterwards.
I'm going to bring Amanda Chang up, my coworker, who is our expert on some USDA programs. And we've really invested a lot of time and energy into USDA programs, some of them at this point, because of, and primarily, or substantially, because of the equity initiatives going on at USDA. Is it perfect? No. Have there been roadblocks with Midwest farmers who think that they deserve, that they're equally trodden on? Yes. However, they're still moving forward. There are still some good initiatives focused on equity at the USD level, and we're going to try to maintain our connection with those and our ability to educate and support producers and access them. So Amanda, why don't you come on up and just say a few things.
Hi everyone, I'm Amanda Chang. I'm with the CARE Project, and I focus specifically on supporting folks with USDA services. So I know a number of you, I think, are here with representing nonprofits or interested in nonprofits. So unfortunately, the resources at USDA tend to be limited to commercial farmers. But I just wanted to kind of just share that as an additional resource, since it is a source of loans and grants. So for USDA loans, those loans tend to be lower interest loans than what you could get at Farm Credit East, than what you can get at commercial banks. So it's a pretty good option for those who are just starting out. So in terms of USDA loans, they have loans for beginning farmers or small farmers up to $50,000, and that tends to be a much more simplified loan process. Other loans are available up to $400,000 to $600,000, depending on if it is for just general operation expenses or if it's to purchase a farm. And they also have a number of different programs that allow you to get like partial funding or to guarantee funding from a commercial bank. And so in addition to that, so that's on the loan side. There's also like crop insurance and disaster assistance. And those programs are definitely programs that if you are farming commercially, or even if you are a nonprofit farmer, I think you can qualify for some of the disaster assistance programs. But those are just really good ways to manage risk. So I know we talked a lot about financing today, but one thing that we always also recommend at the CARE Project, and I think a lot of our fellow nonprofits, including the conservation districts, is like thinking about how to manage risk and like if things go wrong. So just all good, really good resources to be aware of. Any questions at all about like the federal grants or the federal loans? Yes.
When you say commercial, it means you have to be like a for-profit, like LLC type thing?
No. So commercial, by that what they mean is that you are selling your like the farm products that you're producing. So on the loan side, Definitely, you cannot be a nonprofit. Unfortunately, that is just one of their qualifications. But on the disaster assistance side, you can be a nonprofit, but you need to have a portion of, like, you need to still be selling commercially in some way. So sometimes a nonprofit will have like a social enterprise arm. So they are like producing, I don't know, you're growing on like your garden plots and you're selling that, but then you're taking that money and putting it back into your nonprofit and education. Like that is allowed. That amount just needs to reach $1,000. But that would open you up for like disaster assistance. So let's say like a flood wipes out everything, like there would be programs available to help recover the costs. And then crop insurance would be exactly what it sounds like. So you're insuring your crops again from loss. Crop insurance very much is directed towards commercial farmers. So if you're going in because you want to start a farm business for yourself or your family, those would definitely be really good things to have, just so you don't lose all the investment you've made for time and money. So if anyone is interested, like we are here as a support system. You can also, of course, go directly to the USDA. So in Rhode Island, we're small enough that our county and our state office is one and the same. So it is actually it is in Warwick. It's right off of Ball Hill Road on Quaker Lane. So if you like that whole commercial strip, like right next to that commercial strip is where the USDA office is. If you want to reach out to them, we can direct you there, or the other thing is just make sure that you're calling ahead of time. I don't know if they're taking walk-ins right now because of COVID. They were doing appointment only for quite a while, but they're a really great resource as well. But they are like federal funding versus like Josh and other resources that we talked about are state resources. But I kind of want to just make sure that everyone knows like the full range of available resources out there. Okay. Thank you all. Thanks.
That's the end of the presentation.